Picture this. It's the 1920s, the roaring 20s. Jazz is in the air, people are dancing the Charleston, and everyone seems to be getting rich quick. The stock market was the place to be, a seemingly endless escalator to prosperity. But what if I told you this decade-long party was about to come to a crashing, screeching halt, plunging the world into its worst economic nightmare? Today we're diving deep into the story of the 1929 stock market crash and the dawn of the Great Depression. So how did it all go so wrong? To understand the crash, we first need to understand the boom. After World War I, the United States entered a period of massive economic expansion. New technologies like the automobile and the radio were changing daily life. Factories were churning out goods, and consumer confidence was soaring. This optimism spilled over into the stock market. People saw stocks as a one-way ticket to wealth. Stories were everywhere of ordinary people, from janitors to teachers, making fortunes overnight. This created what we now call a speculative bubble. It wasn't just the rich who were investing. It was everyone. A particularly risky practice called buying on margin became incredibly popular. Imagine you want to buy $100 worth of stock, but you only have $10. With margin buying, you could borrow the other $90 from a broker. As long as the stock price went up, you were golden. You could sell the stock, pay back the loan, and pocket a handsome profit. But what happens if the price goes down? Well, that's where the trouble begins. If the stock value dropped, your broker would make a margin call demanding you pay back the loan immediately. If you couldn't, they would sell your stock to cover their losses, pushing the price down even further. It was a house of cards, and all it needed was a little gust of wind to topple over. Throughout 1929, some cracks started to appear. Industrial production slowed, construction was in decline, and the agricultural sector had been struggling for years. A few savvy investors saw the warning signs and quietly began selling their stocks. But for the most part, the party raged on. The market hit its peak in early September 1929. Then it started to wobble. Prices dipped, recovered a bit, and then dipped again. Public anxiety began to grow. The tipping point came in late October. On Thursday, October 24th, known as Black Thursday, panic set in. The market opened with a flood of sell orders. Prices plummeted. In a desperate attempt to restore confidence, a group of powerful Wall Street bankers pooled their money and started buying up huge blocks of stock. It worked temporarily. The market rallied a bit by the end of the day. A sense of cautious relief spread over the weekend. Many hoped the worst was over. They were wrong. The real catastrophe struck on Tuesday, October 29th, a day now infamously known as Black Tuesday. The panic from the previous week returned with a vengeance. The bankers who had intervened before were now powerless. The floodgates opened. Everyone was selling, and almost no one was buying. A record-shattering 16 million shares were traded in a single day. The ticker tape that reported stock prices fell hours behind because it couldn't keep up with the sheer volume of trades. People watched in horror as their life savings, their dreams, their entire fortunes evaporated in a matter of hours. By the end of the day, the market had lost billions of dollars, an amount equivalent to trillions in today's money. The bubble had burst. The crash wasn't a one-day event. The market continued its brutal slide for years, not hitting its bottom until the summer of 1932. But the immediate aftermath was devastating. The margin calls I mentioned earlier, they came in droves. People who had borrowed heavily to invest were wiped out. They not only lost their initial investment, but were now deeply in debt to their brokers. The psychological impact was immense. Confidence, the very fuel of the economy, was shattered. So how did a stock market crash lead to the Great Depression, a decade-long global economic catastrophe? Think of it as a domino effect. First, the crash destroyed wealth. Millions of individual investors were ruined. But it also hit banks hard. Many banks had invested their customers' money in the stock market or had made loans to investors who were now broke. When people, fearing the banks would fail, rushed to withdraw their savings, it created bank runs. Banks simply didn't have enough cash on hand to pay everyone. Thousands of banks across the country collapsed, taking the life savings of ordinary citizens with them. With people losing their money and banks failing, credit dried up. Businesses could no longer get loans to invest or to cover their operating costs. Seeing their own savings disappear and fearing for their jobs, people stopped spending money. They bought only the absolute necessities. This drop in consumer demand was a death blow for many companies. If no one is buying your products, you can't afford to keep your factory open or your employees paid. This led to mass unemployment. Factories shut down, businesses closed their doors, and workers were laid off by the millions. By 1933, the unemployment rate in the United States had skyrocketed to a staggering 25%. 1 in every 4 workers was jobless. For those who managed to keep their jobs, wages were often slashed dramatically. This created a vicious cycle. Unemployment and lower wages led to less spending, which led to more business failures and more layoffs. The Depression wasn't just confined to the United States. America's economic collapse had a massive global impact. The U.S. had been a major lender to other countries, especially in Europe, which were still recovering from World War I. When the American economy crashed, those loans dried up. Furthermore, the U.S. government passed the Smoot-Hawley Tariff in 1930, which raised taxes on imported goods to record levels. The idea was to protect American industries, but the result was a trade war. Other countries retaliated with their own tariffs, and international trade ground to a halt, spreading the economic misery around the globe. Life during the Great Depression was incredibly difficult. Families were torn apart. People lost their homes and were forced to live in shanty towns, derisively nicknamed Hoovervilles, after President Herbert Hoover, who was blamed by many for the crisis. Bread lines and soup kitchens became common sights in cities across the nation. Farmers in the Dust Bowl region faced an additional environmental disaster as drought and dust storms destroyed their land, forcing them to migrate west in search of work. The Great Depression was a defining event of the 20th century. It reshaped the role of government in the economy, leading to President Franklin D. Roosevelt's New Deal programs, which created Social Security, federal deposit insurance, and new regulations for the stock market, many of which are still with us today. It taught us painful but valuable lessons about the dangers of unchecked speculation, the importance of a strong banking system, and the interconnectedness of the global economy. The story of the 1929 crash is a powerful reminder of how quickly fortunes can change and how fragile economic prosperity can be. It's a tale of euphoria and despair, of a party that ended in the worst way imaginable, leaving scars that would last for a generation. Thank you so much for watching. If you found this journey back in time interesting, please hit that like button and subscribe for more deep dives into history. Let me know in the comments what historical event you'd like to see covered next. See you in the next video.